Okay, guys, the next edition of the Watchers/Officials. We have a very important show for you today. Is peace is breaking out between Ukraine and Russia. And who did it? The man. He is doing it. And he is meaning and doing what he said before he got elected. Now we need to review what that means for oil markets, metals markets, gas markets. So we are going to have a show later on where we explore all these things in great detail with my colleague Harry and several others and see what we found out.
Let's say we're seaside, low tide, sun going down. Running up the creek gives a wave crashing kind of sound. Between the cornfield and Johnson's farm, round the hook of the hollow, past the old red barn, where the dirt road ends, there's a place we pretend we're kicking back on the coast somewhere. No, it ain't Maui, it ain't destined. Just some good old-fashioned country ingenuity. It ain't a moon or Fiji, but this tiki light lawn chair, my top fantasy is a nice slice of...
Good afternoon from cold London, as Brent is about $75.10. So what are the big things going on? Well, the big things are from peace plan. And that caught even the German leader, Mr. Scholz, by surprise, according to the various reports. I was kidding around at lunch, having a very nice sushi lunch with a friend of mine who is from Russia, who got very angry over this. But hey, that's life, right? It's Trump's week. Peace is breaking out, and he's playing it on his own terms, not with anyone else. And I was telling my friend that Europe is not in the driving seat. In fact, Europe is not even in the car. So this is all led by the Americans, and without American money, there is war. So this war is ending. And as the war ends, all the terms and conditions surrounding the war will also end. And part of what we are thinking here is, what does that mean for many markets, from gas to metals to oil? And the overwhelming conclusion for us is, at least for me, is that the war will end fairly quickly. And yes, Russia won, is the case. Europe lost. But this means great things for Europe, because Europe will have access to molecules again, gas, metals, things that they need to convert into industrial goods and consumer goods. So Europe hopefully can again grow. And I think many of my European friends don't see it that way. They're kind of sad. They feel excluded from the process, but actually it's very good. They don't know how good it is, because the price of many commodities and the access to those commodities will become easy again. So I have here my colleagues, Ed, Will, and Harry, and I wanted to invite Harry as to how do you see the line of travel in those commodities as peace hopefully breaks out?
As you said, that's the line of travel. I think what's really interesting is, if indeed you are correct in having a rapid resolution and some kind of peace deal and eventually the end of the war, I think the U.S. is probably going to throw in terms of negotiating offers, the lifting of sanctions. So if the U.S. lifts sanctions on Russia, be followed by the U.K., which probably is going to force the hand of the EU to follow suit. So the price caps on crude oil, price caps on oil products, they get lifted, and therefore Russia has geographic optionality again as to where its crude and products are going to go. So we could think about a reshuffling of oil flows. The main destination under a sanction regime was India, but that could flow back to Europe. We're looking at products such as diesel, possibly coming back into Europe. Going to be affecting, obviously, diesel cracks, east-west spreads. And as far as Russian crude, if it starts heading west again, then Brent-Dubai differentials are also going to be affected. So there's a whole number of segments in the market, like you were saying earlier, that are going to be transformed if we get a resolution and indeed the war ends quickly.
Yeah. From the way we have seen it and discussed internally about it, the time that the oil and the commodities are in transit will be dramatically reduced. And that is almost like a bump in supply coming into markets, which then causes them to tune. And that is very good for the consumer. It's very good for Europe because Europe has been paying through the nose. Only 2 days ago, we were very concerned about the price of gas going through the sky. And then TTF was hitting some high levels. And then what do you see, Will, happening in that market now?
Yeah, well, TTF has kind of flushed out today. At some points in the day, we were down about 9% on the day. We were trading at 59, so everyone was really concerned. Obviously, that's a huge factor for energy costs for the industrial complex in Europe. And earlier this week, we were seeing day-ahead power futures trading about 40% higher on a year-on-year basis than 2023. So everyone was getting very concerned. But yeah, this will alleviate a lot of concerns there.
Yeah, 2 days ago, all the discussion was about TTF going up, LNG going up, the inventory is not being high enough, big problems for next year, blah, blah, blah. And suddenly everything collapses as it should because there is a sense of normalcy. What surprises me is how upset the Germans are. Scholz was very upset. It's almost like, I guess in their mind, they were beaten again by the Russians. But it's not about winning or losing. It's about your people. Are you people better off or worse off? But go ahead, Harry.
I just want to add a little bit to what Will was saying, because obviously constraints on gas supply, raising costs in terms of industrial production, but also the refining sector. At the end of the day, you need natural gas, you need methane to essentially produce the hydrogen that you're going to use to desulfurize your products. So if you think about it, cheaper gas is not only good for industrial output in the broad sense, but again, in terms of operating refineries, because that was an issue when back in 2022, the prices of gas were rising, and then the true profit margin or the true refining margin, if you will, had to be adjusted for that higher cost of gas, which obviously feeds into the price of products. So net, if we do have a rapid return, we're talking about Russian oil products, but Russian gas into Europe, that's going to make a big difference.
Yeah. So it's really good for the consumer. It's good for the GDP of Europe. But it doesn't feel like a win, even though it's a win. Because Europe is so vested into this bloody war, literally bloody war. So I'm very happy with Trump's moves because they're positive for the whole world. And finally, I was always very negative on Europe and how under all circumstances Europe loses. And only by losing now, there is a glimmer of hope because they can start growing again. And we have seen a lot of markets acting in a funny way. I was sitting down with Ed, and I saw a market, fuel oil, kind of like making a big mountain, then coming off.
Yeah, and it's come straight back down again as of today and yesterday. But that's the theme actually of a lot of the products is yesterday, even gasoline, diesel, fuel oil, they were all coming down. And today, diesel and fuel oil have kept going, particularly in the cracks, they've kept going down. But gasoline has recovered a bit, firmed up, it's risen slightly, so there is a bit of a differentiation between the products there.
But anyway, before we talk too much about Trump, we should also focus on the broader economy. And Will, you had some thoughts about the fundamentals?
Yes, yeah. So I'll start off with China. I think that's been quite a big focus. So recently we had some reassuring housing data from HSBC come out, which noted that home sales in 30 cities largely escaped contraction year on year in January, with some major cities actually posting increases. Shenzhen, for example, which
China's back.
which is
Let's not get too excited.
which is where Evergrande obviously was based and arguably was where the Chinese property crisis began. They saw a 60% year-on-year increase in home sales. So, you know, the housing market, although it's flat year-on-year, let's not get too excited. At least it's not
contracting.
It's not getting worse. Equities have responded pretty well. So China Vanke shares are now pricing about 15% higher than they were at their low in January. Sunak shares are up about 45% since mid-January lows. And CPI was a little bit better than expected.
Let me interrupt you there. So China stock market went up.
Yeah.
And I checked yesterday, the Russian stock market also went up. And I foresee that the German market should go up, right?
Yeah.
This is kind of the rebirth we are seeing. And you're going to talk about the inflation rate. But if we are right that all commodities come down, then CPI will moderate, right? So it's all good news, but go ahead.
Yeah, so in China, we've seen a little bit of an uptick in inflation, which for them is also good. That's a sign of improving consumer demand, exactly. So that rose to 0.5% in January, up from 0.1% in December. It'll be interesting to see what the PPI looks like as well. But a lot of that has been driven by vehicle sales, which slowed a little bit in January, but remained strong and continue to look strong in the preliminary February statistics.
Because adjusted on a seasonal basis, they're up big time.
Yeah.
There is always a slowdown following the December sales and during the Chinese New Year. So those things are happening. We're facing them right now, but they're up considerably versus last year.
Yeah,
I think we always have to look at it from the base level off of which they're recovering. Before, I mean, yes, it's good news, but 2 years of degradation, deflationary pressures, and now it's just beginning to turn a corner. So it'll be interesting to see if that trend continues, because maybe the impacts of monetary policy easing, fiscal easing, for which I personally think they need to do more. But if that is beginning to filter through this year, then maybe they're going to be turning a corner. And as they turn that corner, the improvement in China also helps in terms of commodity demand.
And that could mean a growth in oil demand, says OPEC.
Says OPEC. They're still optimistic. They're still saying 1.4 million barrels per day of demand growth this year. So they kept the same number from their December report to their January report. But naturally, OPEC and the IEA, they're never going to agree, are they? I mean, the IEA is 300,000 barrels per day less, and they're predicting the 1.1 million barrels of growth. And they can't even agree on Russia alone. The IEA sees 240,000 more barrels per day produced in Russia than OPEC does. So,
and
incidentally, ONEX's own forecast is 1.1 million barrels a day. So we're being a little bit more cautious on the outlook. OPEC's enthusiasm also kind of fits a scenario. You want to return barrels to the market as planned in April. Obviously, having a more positive outlook on demand and a more negative outlook on oil supply outside of the OPEC Plus group certainly allows you to therefore reinforce your decision to bring those barrels back. But again, we also know that that decision is also going to depend on where oil prices are. But it's an interesting one. They're still following the same sort of playbook.
So for me, I was probably the most negative in terms of consumption, way under all scenarios, just because I saw the deterioration in the economies. But now that we see the glimmer of hope, maybe lower oil prices, then there's nothing like low oil prices to cure oil prices and to cure demand contraction, right? So maybe we'll have more growth than anticipated if things turn out well for Europe. And we need to observe and always monitor all those critical changes. So with that, what else do we have in terms of major events coming in? Well, in terms of major events, tomorrow there is a meeting in Munich. Vance, the vice president, is going to lead that discussion alongside with Rubio. And it seems to me that the line is very clear, is negotiate an exit of this war as quickly as possible And if that happens, guys, I think then things will turn out much better for the world, higher GDP, lower oil prices, and then we'll keep you informed. Other things happening in the market, we had an announcement that last week by ADNOC that the price of Murban was below the price of Upper Sacco. We're trying to get our heads around it. Apparently, there are some announcements by a PRA that will solidify that inversion. So things are a little bit weird in those markets following the mega squeezes of the past 3 months. So we'll see what happens. But to conclude, I would like to hand it over to Harry to have the closing big picture.
I just wanted to sort of a continuation a little bit in terms of the macro themes, because obviously there are a lot of positive, but again, this week we had inflation data out of the US as well, exceeding expectations, and Jerome Powell testified in front of the Senate, House Financial Committee, essentially saying that the Fed was not in a rush to lower its policy rate. This, as Donald Trump was clamoring on Truth Social that he needs lower interest rates because somehow they go hand in hand with his tariff plans. So I think in terms of balancing some of the enthusiasm we could have in risk assets or even prices of commodities is the fact that the Fed is going to probably stay on hold for longer. And that's sort of a countervailing argument. Let's see which one is going to prevail more in the psyche of the market. Firstly, for oil, and I think you have the same view. Yes, we're holding at 75, but dropping lower from here, returning to the sort of levels we had in the middle of Q4, low 70s.
Correct.
And I don't want to sound too bearish, but I think we could test a 60 handle.
Again. Yeah, we will definitely do that. So keep an eye on us and also read our newest report, the liquidity report that gives you momentum and discrepancy indicators, all available through our media and also in LinkedIn. Thank you very much.